Let's get though to the private markets now, and Patrick William Rixon, Capital MD, joining me in studio. Good to see you, Patrick. So we're discussing here private credit secondaries and whether the risk reward makes sense. What are private credit secondaries to start with?
So take a private credit fund, a closed-ended fund with a finite life. They've got a portfolio of loans that can't be refinanced, or for some reason they want their money back quick. So they'll sell into a private credit secondary fund at a discount. So that's really what a secondary fund does.
And so when we talk about risk reward, let's start with what are the risks here?
First thing you got to ask is, debt's a finite product. You're writing loans for 1, 3, perhaps 5 years. If you're looking to sell at a discount and get out early, first question is, why are you selling at a discount and taking a loss? Secondly, a lot of these debts out of the US market, they tend to be LBO financing. So think 5-6 times debt to EBITDA, written 2-3 years ago. A lot of these businesses aren't going to be doing as well as they did then. So that's a lot of risk for a return that's, call it 6% cash yield and a long-term return of 10 to 12%.
So that is the return profile there?
That's the target return profile.
Okay, and so then what would you say to people that are a little bit nervous about getting into this? I mean, that sounds like a pretty good return there.
I'd say you should be pretty nervous in the sense, because at the end of the day, you choose the best risk-adjusted return based on the options available to you. So if you're a US investor, a 6% yield and 10% long-term is attractive because it's a deep competitive market. So those returns are high for the US. The Australian private credit market is nascent. So you can get those returns in boring, lowly leveraged asset-backed strategies. So my messaging to investors, if you're Australian, you're actually better off sticking with a domestic fund.
Now, Patrick, you were telling me in the break you've been travelling around the country. What have you sort of learnt in terms of investor appetite for private markets?
Look, the appetite's still there, but unfortunately, investors have been spooked. So I think that First Guardian debacle is one, the downgrade from metrics is the other. So we're doing a lot of firefighting. People are asking, how do you run your business? What exposures have you got? And they're sort of comparing and contrasting to make sure they're not caught in a bad spot. So it's unfortunate that, some issues in the market have really flooded through and caused concern for investors.
Yeah, and that is huge, all those people losing their retirement savings essentially. What would be your advice when you're looking at some of these riskier products?
My advice to investors is, you've got to understand what you're putting your money into. If you don't understand, it doesn't matter how good the returns are, how good the pitch is. It's a gamble. So A, understand the product. B, get advice. Get really good advice. And I know First Guardian's a terrible example because it was wealth advisors who put people's money in. But that's an issue for ASIC because those are very different breaches.
Do you think that because ASIC is involved, it's unlikely we'll see something like that again, or it's hard to say?
It's hard to say. I suspect this may not be the last of what we see because there'll be players out there who've raised and deployed money over the last 2 to 3 years who haven't been caught yet. So I expect you will see a little bit more pain in the market before things get better.
And Patrick, does that example also just tell us, never put all your eggs in one basket, particularly when it comes to something huge like your retirement savings?
Absolutely. I mean, there's a reason people talk about diversification. So you can afford, no one likes to lose 10%, but you can afford to lose 10%, retain the rest of your portfolio. That's painful as opposed to devastating.